Good afternoon, everyone. Thank you very much for joining this lunchtime webinar, which is one of the series of webinars that we've been doing over the last few months. For those of you that don't know me, my name is Nick Sharon-Lambus, and I'm the Managing Director of Alpha Wealth, and I'm joined by several of my colleagues this afternoon. We've had a record number of registrations for this particular webinar, so obviously it's gained a lot of interest in helping you to save tax that you pay this year. And I'm going to run through over the next 25 minutes or so some areas in which we feel that you can avail of that will absolutely help you. Please, for anyone who would like to ask any questions, please do so in the Q&A, which is on the top of the Zoom link there. And as I say, we want to make this as useful and as interactive as possible. So just before I do that, my colleague Keenan is just going to launch a poll just while we're waiting for one or two others to join. And if you could just maybe populate it, that would be really helpful. We're just asking a question about what, how much tax did you pay last year? Just get a kind of a feeling for how much tax people have suffered. So just while you're doing that, just to mention briefly, for those of you that are not familiar with Alpha Wealth, we're a very progressive company with offices in Cork and Dublin, 9 qualified financial individuals with over 60 years of experience, essentially managing over 100 million of assets. And for anyone who wants to sort of see and get a better sense of us, please look us up on Trustpilot and look for any kind of financial reviews. So basically, what we're hoping that you will get from this webinar is to find out a little bit more about a tax scheme that's available to you that will allow you to save at least 4,000 euros in tax, what the options are for this scheme, and lastly, just to how to claim tax back this year, going back over 4 years. I'm not going to talk about pensions today. For anyone who has an interest in pensions, there are webinars that we have done previously over the last couple of months that will focus more so on that. That's another opportunity for you to benefit from getting tax back, but I'm not going to focus on that today. So I'm just going to start by talking a little bit about the EIF scheme, and my colleague Keenan's just going to run a second poll, if that's okay, just in relation to that particular aspect. And thank you for those of you that did answer the tax question. I can see quite a lot of you paid quite a significant amount in tax this year, or last year, I should say. And obviously, I think this will be very, very relevant to you. So what is this scheme? Well, it's called the Employment Investment Incentive Scheme, or EIIS more commonly. It is a government-approved scheme. It's a 4 to 5 year investment. Typically 4 years is the minimum term. Generally, it should run for not much longer than that. And by virtue of you making an investment of which a minimum contribution of 5,000 euros qualifies you, you can get 40% of that contribution back from the revenue. The example on the bottom of the screen there is that if you have, say, earnings of 80,000 a year, and that may include rental income, you can invest approximately up to about 40,000, because that's the amount of income that you pay at the higher rate, and it is a singular person scheme.
So Nick, just on that, I suppose, can you explain to people on the call what the difference is between the EIF scheme, investing in that, and maybe then putting money into your pension?
Yeah, this is a common question that comes up quite a lot. People don't necessarily understand the differences. Well, from a tax perspective, they're the same. If you put in 10,000 euros into a pension or 10,000 euros into an EIF scheme, you typically get 40% back from revenue. That means it's cost you 6,000 euros. And if you think about it, that's a 66% gain, not a 40% gain, because to turn 6 into 10 requires a 66% increase. The difference between them are an EIS scheme can go from 4 to 5 years. A pension may be 20 plus years. So depending on your age, it may suit you to put money into an EIS scheme if you would like to get access to that money, obviously within 4 to 5 years rather than waiting the 10, 15, 20 plus years. The other thing I would suggest is that I like pensions from a monthly savings aspect, particularly from salary, whereas EAAS is a lump sum investment scheme. It's out of money that you have either from a bonus or from selling shares, or indeed money that you have sitting idle in a bank account.
And with the EIS, then, do you prefer investing in a single company or in a fund?
So we operate as independent brokers, and our job really is to find the best companies. And there's a variety of companies out there. There's about 70 or so each year that look for finance. On the screen there, you can hopefully see 3 of them that I'm going to talk about that we believe are the best companies currently in Ireland looking for this type of finance. One of them is Blacks of Kinsale. The other is a renewable energy fund called BVP. And the final one is called Clistra, who have just set up a new opportunity that I'm going to start with talking to you about today. With regards to whether a fund like BVP or a singular company, there are pros and cons, and I'm going to sort of touch on those today, but it's good to have the variety and to give people the choice of what they feel most comfortable with. We're not trying to force you into making a decision on this. Our job is to give you the information. And what I would suggest is that hopefully by the end of this call, and ask any questions, please, on the Q&A, that you will be educated enough to know exactly what the opportunity is and whether or not it makes sense to you. So let's talk about Clistra. This is a new opportunity, as I said, run by a company that own a number of hotels, bars and restaurants. You can see on the screen there, there's about 22 that they currently own, including a number of Radissons in Limerick, Cork, Athlone, the Muckross Park Hotel, Dublin One, and so on. And essentially what they're doing is they've just acquired a bar stroke restaurant called the 2 Mile Inn, just outside Middleton in Cork. For those people from Cork, you'd probably be familiar with it. It's basically on the outlet to the Greenway, East Cork Way, which has been very popular with cyclists and motorcyclists. And it's a huge opportunity for Clistra to basically develop this property further. They did one recently, which was in West Cork direction, which was basically the same sort of opportunity that they provided, called the Viaduct. And they have great expertise and wherewithal to turn it into a very, very lucrative opportunity. This was a short snippet from a prospectus that we can forward on to you. And they've done a lot of detailed analysis of the local market. They're very knowledgeable. They're actually headquartered in Cork. And you can see there that they've given quite a lot of analysis in relation to the opportunity. There's a huge opportunity for a bar of this type in that particular location. There's not a huge amount of competition, and they know exactly what they need to do, and they have the wherewithal and expertise, and indeed the employment staff to actually provide that opportunity in that region. And I think it's a great new venture for people to get involved with a trusted company. The next one I want to talk about, we raised money for last year, is Blacks of Kinsale. They're raising some further monies, which is available now. It's not going to be available for the full year. They're going to do a short raise just to finalize getting more stock and finishing off basically a multi-distillery plant that they have been essentially building since late last year. The company has been very profitable. They raised a profit of about 600,000 last year and the year before. And I'm not sure if any of you drink whiskey or are familiar with Blacks, but they're a very, very reputable company. I met with the owners on several occasions, and I've been hugely impressed by them. The picture that you can see on the screen there is the current progress of the distillery. They bought the site. We will provide you full analysis of exactly what that money is being used for, and that is going to open later this year. They're going to invite all people that have invested in the scheme, and anyone that lives, I suppose, nearby, particularly in Cork, you can go and visit them and you can speak to the owners directly if you so wish. The final opportunity, as I said, will be available later in the year. It's a fund that's been ongoing for the last 15 or so years through a company called BVP. And basically what they do is that they provide and give guidance to invest in companies in the renewable energy space. That's solar, obviously water and so on. And it's again another option, and it diversifies, I suppose, anyone's portfolio risk, where you can invest in one or more of these companies, depending on the level of investment, obviously, that you're making.
So Nick, I'm going to just ask you a few questions just on the EIF scheme. So firstly, are there any risks associated with investing in this scheme?
Yeah, there absolutely are. Anybody that tells you that you can get essentially 100% of your money over 4 to 5 years, and the reason I say 100% is that if you say had a 10,000 euros in the bank, or if you're receiving that money from a bonus or sale of shares, and you put that into this scheme, you'll get 4,000 euros guaranteed back from revenue. And after the 4 to 5 year period, and I appreciate, you might say, is it 4 or 5 years, but that's generally the period in which this scheme runs for, that you'd expect your money back plus a return of about 20% net of fees and tax. So obviously that's 6,000 net investment for a 12,000 return, 100% return. And therefore you should understand, of course, there's risk. If you earn next to nothing in the bank with no risk, how can they give you 100%? And basically the risk is that one of those 3 companies or other companies that I wouldn't touch with the barge pole may not be in a position to give you your money back. And that's why we'd only invest in companies with a good track record that have traded, that we have a lot of wherewithal in terms of making that money back for you. And all you need is that company to be worth the same as it is today in 4 to 5 years' time for you to get your capital back. You do not need the company to grow extensively. The cap that you can see here is the return maximum that you'll get from those companies. And our job is to obviously offer the companies that pay a fairly lucrative amount to you, the returns of which are about 20 to 25% over that period, with the tax relief that you get from the government. And if you think about it very simply, guys, getting 40% from the government in a 4-year investment is 10% per annum, guaranteed tax-free. It is really a lucrative money for jam option. And of course, yes, there's risk that the company won't be in a position to pay you back, but that's why we select them very, very carefully. And you have to understand the risk-reward trade-off. But with the tax relief, we feel it's very, very advantageous.
So you've showcased 3 of the companies today, Nick. Is there a full list of the companies that are eligible for EIF?
No, unfortunately, there's not. The reason for that is that companies can set up an EIS scheme quite quickly, and a company might set one up this week, for example. So it's almost impossible for there to be any kind of listing. Now, I wouldn't look at any companies that we're not familiar with. So again, I see these advertised, and if you look at like the Sunday Business Post around October, November time, you see kind of every man and his dog advertising to raise finance. And a lot of them are just somebody's idea, it's a brainchild of, oh, I think this is a great idea, I think we should raise some money. Again, in my opinion, and having a lot of experience, I've been in the industry for 25 years. I've been involved in EIS for 11 years since it was launched, and then there was a predecessor to that. I'd be very, very mindful of which companies you select. And honestly, in my opinion, those 3 companies that I've mentioned are the only 3 that I would touch this year. And by the way, this opportunity is likely to end next year. Pascal Donoghue said in the door 2 years ago in the budget that it was going to run for a further 3 years. This is the second of those 3 years. Whether it continues into next year or not, we don't know. Hence why I would take advantage of this opportunity as soon as you can.
So for anyone that is interested in maybe investing in one of these companies, can you explain the fees that are associated with the EIF scheme?
So not many financial brokers advertise EIS, and many of you may not have heard of it and wonder why, given the scheme has been available for so many years, you haven't. And the reason for that is that, being totally open about this, it doesn't pay financial brokers very well. They'll make more money by selling you an investment of some description as opposed to putting your money into EIS, and that money's obviously tied up, so they won't have access to it within that period. Neither will you, by the way. The fees you can see again on the screen, we have basically agreed the most favorable fees with those companies, and the highest fee is BVPs. There's a slightly higher fee because they offer a fund, which is 3% of your investment capital. So if you put in 10,000, that's a fee of €300. That's an all-in fee, by the way. It's a one-off that you pay at entry. With Blacks and Clistra, the fees vary between 1% and 2%, and that's the only fee that Alpha Wealth will receive. So I would argue that, you know, for 5 years or 4 years of money, receiving say 3% on 10,000, which is €300, is not a particularly, you know, attractive fee for the work that we do and the ongoing advice and updates. But to answer your question in short, they are the fees.
Okay, so can you exit from these early? I know you kind of touched on it there a minute ago, but and also can you explain what's the longest period that these run for?
There is no facility for an investor to decide to take their money back out. And that's, again, part of this risk reward. So you must understand that the reason the revenue give you 40% and the companies pay you interest is that you are lending them money to grow. So obviously your interest and theirs are aligned, and you're helping them to, I suppose, get to the point of which they will repay you, of course. If you take Blacks, for example, by giving them money to fill out the distillery that they're obviously building, it's going to enable them to seek further markets and make more money. And the same for Clistra and BVP, of course. And therefore, you have to understand that, you know, you're at the discretion of the company to pay you back, but they're incentivized to do so, because if they delay repayment, there are penalties that are provided, and they typically pay you more interest holding on to your funds for longer. And
there's a lot of questions coming in. There's a lot of questions coming in, and I might just ask one more, and then we'll address them at the end. But can you explain what's the maximum amount you can invest yearly when you're on, let's say, 50,000 and want to ensure that you get 40% tax back? Or does it differ for somebody maybe that's married? Can they invest more? So maybe you just address that question around what is the maximum people can invest.
So this is where we help you guys, and we have a lot of tax experience and guidance. And again, we help you identify the opportunity for you specifically. Now, if you're in a relationship with someone where you're both high rate taxpayers, typically the cutoff or threshold point is about 40,000 of earnings per year, then anything above that is eligible for EIS. So if you're earning 50,000, typically 10,000 euros is your limit to what you can put into the scheme this year, and the same for next year, of course. The good thing about EIS, and one of the differences I should have mentioned earlier, is that if you have a pension scheme, you can only offset the tax relief against earned income, i.e. money that you're paid by a company. For EIS, that includes rental income. So anyone who has an investment property and they're getting screwed on tax with, my advice to them is look at EIS as an opportunity to reduce the tax you pay by investing in the scheme annually. And as I said, this is a limited opportunity, guys. You've got this year for sure. We don't know about next year, and then the scheme ends.
I'll come back to the rest of the EIS questions after the rest of the presentation.
Super. I just want to talk briefly, guys, about tax back. And this is the last of the polls which Keenan's going to put up today. And thank you for submitting the questions. I can see a number of you haven't done EIS previously, and obviously, you know, it might be something for you to explore further. And we are going to provide the slides and the video for anyone who may have missed part or wants to listen back to that. But we are available to give you this guidance and explain to you. But more importantly, is provide you with the prospectuses for these companies. Just in relation to tax back and what you should claim for. Essentially, there's a lot of things that I feel that POA workers particularly do not claim for. Anyone who's renting, you can claim for a tax credit for last year for €500 and this year for €500. If you got married, for example, over the last 4 years, it's important to make sure that you've informed revenue because you will be eligible for further relief. For myself, I always do a tax return, and I'm going to show you shortly how to do that, but it's really helpful. And the key thing is that you need to know that if, for example, let's say, you've made pension contributions or tuition fees you've paid or worked in the UK. I did a webinar last night for people to claim back the UK state pension, even if they've left the UK over 20 years ago. I myself worked there until 2000, and I'm in the process of buying back up to 17 years, again, as a limited opportunity that's available to me. So I feel that this is an area that we often kind of overlook, and possibly because we're maybe time poor, and our role is to help you understand and make sure that you're benefiting from this. And the most easiest way to do this, guys, is just set up on the Ross system, the revenue.ie, go into my account, and I'm going to show you the process. And again, I'm going to share this slide deck with you. Just set up an account. You only need your PPSN number with your identity, which is obviously a driving license or passport, and get set up, and then go into the system and claim for the relevant release that you should be. It's very simple. And if you want some guidance and help from us, we can provide that and support you with it.
So Nick, on that, can you claim for tuition fees that you've paid for a child?
You can for third level tuition fees, yes. There's a 20% claim that you can make for third level education fees.
Okay.
Is that okay?
Yeah.
Now, I'm just going to mention briefly about our next webinar, which is on the 18th of April at 7:30 p.m. And my colleague David Looney is going to talk about savings accounts and the best accounts in Ireland for children, grandkids, and also for adults, I should add. And we're also doing this to coincide with a €100 cashback offer that we're providing back to you personally for anybody that sets up an account with us before the end of April, subject to the normal T's and C's. It's a minimum contribution of €300 a month on any new plans that are affected. Now, just before I kind of mention a giveaway that we're doing today, the final thing is that we provide a 1-hour full consultation process over Zoom or in person, normally at €199. It's discounted by 50% for anyone who's on this call or listening to it on playback. We're happy to explain the EIF scheme at no fee. I'm happy to take any questions that people have. Please email me or put them into the Q&A. I will leave it open after this call if anyone does want to ask me questions, and we will come back to you. But this review, guys, is to help you financially plan and make sure that you're reducing the tax you pay. And we're really helping our clients to get to a point of what I call financial independence. When do you get to a point where you don't have to work in your present employment and decide that you're working because you want to, as opposed to because you feel that you need to? And we put together a very simple analysis for you. We do all the heavy lifting, and there's no drama with this. Anyone that's engaged with Alpha Wealth before would have had some, I suppose, semblance of this. And again, we can go through that process with you. So I'm just going to basically mention that.
Do you want to take some more questions before you deal with the competition, Nick? Because there are plenty of questions there.
Okay, yeah, let's do that.
Okay, so in relation to Clishta, have they used the EIF scheme previously, and what was the outcome for investors?
They haven't, and the reason they haven't is because they haven't needed to. They've raised money successfully. We basically had an opportunity where we dealt with them previously through the viaduct, as it was, and now there's an opportunity for them to use this as a vehicle. It's kind of like a one-time option for them, and it makes complete sense. The fact that they haven't used it previously is not a downside. It's knowing a bit more about the company and how they basically position themselves through what was a very challenging, obviously, area for hospitality. But I can tell you now, we're actually located just across the road from the Radisson in Little Island, and the hotel has performed fantastically well. And Clishta have obviously provided some financial details that we can provide you, and you'll get a much better sense of exactly how that company is operating.
So in terms of the EIF scheme and the payout from revenue, when does revenue pay out? Is it at the start of the investment? So maybe you could just clarify that, please.
So when you make an investment into EIF, the tax relief or tax back from the government, so you basically get a refund of tax that you paid in this year. So anyone who invests, let's say 10,000 in March or April 2023, it's in the first quarter of the following year that you'll get your 4,000 euros back. We will provide you with a cert. We'll explain to you exactly what you need to do. It's really, really simple. Again, using the ROS system or sending the cert to revenue. We'll actually do it for you if you want us to, and you'll get 4,000 euros refunded back to you. So basically it's within 12 months.
What about any of the companies that you've dealt with over the past 11 years in terms of the EIF scheme? Have any of them not returned the investment?
The only scenario where companies didn't was during COVID. The reason being is that obviously when COVID struck, these companies have to be valued, because if you think about it, if you're investing in, say, Blacks or Clistra, the company is valued independently, I should add, and you're given rights and provisions, and you have a class of shares that protects your investment, where at the end of the 4-ish year term, the company will be valued again. And therefore, obviously, when that COVID struck, that couldn't happen. But we've got a very, very good record of returning investments to clients. And again, that's why I'd be very selective about the companies that we would nominate. But typically, what we're saying to investors is it shouldn't be that your money's not returned. The only thing that I would foresee is that your money could be delayed. And therefore, this 4 years could turn into 5, which could turn into 6. But no, it would be fairly disastrous for the company not to repay you.
So in terms of Clistra, and in your opinion, do you believe that it's a relatively safe bet as they have applied for the EIF scheme when they own a lot of other restaurants and have no cash flow issues, I suppose?
So one thing to understand is that this particular investment in the 2 Mile Inn is segregated to Clistra's other holdings. What you get is you get their expertise, but the money that's raised is only allocated to the 2 Mile Inn. Now, I can give you a backstory about why I feel it's an attractive proposition. Interestingly, they're going to set up their own coffee pod, if you like, where they're going to make their own coffee. I don't know a lot about that industry, as you can probably tell, but it's a really interesting proposition in terms of what they're offering. And to me, locally, it makes a lot of sense. I think there's a big catchment area. But the fact is that, you know, that particular company has operated very well. They got a lot of government supports, of course, and those hotels and bars are performing very, very strongly. And we expect that with their wherewithal and expertise, especially with this new acquisition, that they'll be able to make sure that this is a success.
Just in terms of this person has asked about, if I already have other investments, is there any impact?
We feel it's really important for you to have a diversified investment portfolio, and that's why we select 3 companies in this space. I'd be interested to maybe find out a little bit more about what investments you have. And as I said, as part of this financial review, is really just to give you independent guidance and advice, not just on your investments, but pensions, ascertaining what risk levels that your investments are in. And we'll help you navigate that, because the last 18 months has been fairly dramatic. Obviously, we've seen big increases in interest rates. We haven't seen deposit rates rise. Inflation obviously has got fairly out of control. And all I'd say to you is that I can certainly suggest that Alpha Wealth and through advisors that we have will help you understand where you are and understand really the direction you're going in, whether it's saving for your children's education, to trying to plan effectively for your retirement, or indeed making sure that you're not going to lose money in any investments that you have.
For anybody looking, there is somebody looking for balance sheet, income and cash flow statements for these companies. Can you provide them if they contact you directly, maybe?
Absolutely. We are going to provide you the 3 different prospectuses on those companies, which provide you full financial accounts. And as well as that, we provide you direct access to the companies if you wish, or via Alpha Wealth, where we've typically got lots of questions and we've answered them directly from the companies to give you that transparency. And what I would encourage you all to do is look deeper into this, get comfortable with the opportunity and ask as many questions as you wish. You need to be very, very cognizant of the fact that there is risk here, and it's really about qualifying that. But if someone has, let's say, 50,000 in the bank and is looking to invest 5,000 into EAAS, that's proportionate to your portfolio. But if you've got 5,000 euros in the bank and you need that money in 4 years' time, that is not proportionate, and I wouldn't encourage you to do this.
Okay, I just have 2 more questions, and then you can announce the winner of the prize, the wonderful prize. So I changed company within 2 years. Now my employer contribution is taken back. So I have 2 options with Mercer. The first is to withdraw money, 20% tax, or transfer my pension fund. Which is the better option?
You need some advice. I'd have to get more specific numbers from you. It depends on your situation as well. If you have the option of keeping the money in the pension fund, that might suit you. But if you need access to some cash, paying tax at 20%, if you got tax relief at 40, wouldn't be a bad investment return. So as I say, it does depend on your specific circumstances. And if you want to reach out to me, I can give you some guidance. You don't necessarily have to go through the financial review if you don't wish to.
I am self-employed and work from home, and my accountant claims for working from home. My wife has worked from home since COVID. Can she also claim working from home, and will it affect my claims?
No, it won't. You can both independently claim. If you have the use of an accountant, I would make them aware of that. But if you want to, again, get the details from us and get her registered on the ROS system, if she's not already done so, it's really simple to do, guys, and we can hold your hand through that process within a couple of minutes.
So that's it, Nick, in terms of the questions. So I'll hand it over to you to announce
Great.
the winner of the prize.
Thank you. So we're kind of bang on 30 minutes. So I'm just going to say, just before we finish up, thank you again for your time. I'm going to pass to my colleague Keenan, who's just going to announce the winner of this wonderful prize. Hopefully you can see here, which is a voucher for 2 people for a one-night stay, bed, breakfast and dinner in all of the locations, barring the Dublin ones. Unfortunately, the Dublin hotels have a slightly different management contract, so they're not included as part of this deal. But as I said, this includes the Muckrows, the Kilkenny Hotel, and others for anyone who wins this prize. So, Keenan, I'll pass it over to yourself.
Perfect. Thanks, Nick. So, hi guys. Hope you're all keeping well. We used a random name generator for this. So the winner is Stephen Lynch. So congratulations, Stephen, and we will get in touch with you after the webinar to discuss how we'll pass on the voucher. So well done, Stephen. Great prize to win.
Great. Delighted, Stephen. And look, it's one of these things that we've been doing. So just finally, I'm going to leave the Zoom open. I saw one more question came in. Please do ask any final questions if anyone has them, guys. And
sorry, Nick, to interrupt you there. You might just share how people can book an appointment, because there has been a question about how people can set up a consultation or book an appointment.
Yeah, Nick, and just to stress, the discount code is savings50, guys, to avail of the 50% discount, and that's all capital letters. So savings50.
Great, thanks, guys. So as Keenan just said there, Keenan has put in how to book an appointment into the chat. It's really simple. Just click on the link, put in that savings code, savings50, obviously for the discounted rate. If anyone has any queries, though, just email me, nick@alphawealth.ie. We're available to provide you with any information you need, and I can provide you more detailed information, of course. So listen, we do appreciate your time. Thank you. And obviously, if anyone does have any comments, we're conscious of making sure that these are meaningful webinars. Please, as well, Keenan's just going to put in one final link into the chat there for any feedback. There's a Google review, and we would appreciate anyone who could just put in if they wouldn't mind, just because it helps us get a better sense of things that we're doing well and maybe things that we're not doing so well. And we really appreciate any feedback from any existing clients, for example, or anyone who has listened to any of the recent webinars. Thanks very much again, guys, and I hope you enjoyed the rest of the afternoon. Anyone listening to this on recording, as I mentioned, this has been recorded on the 29th of March. These opportunities are available typically up until the end of June. So again, we're more than happy to have that conversation with you. Thanks very much again. And as I said, I'm going to leave the Zoom open there for the next